We all need to make smart decisions with our money. The Long-Term Investor Podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Cryptocurrency investors have been clamoring for a Bitcoin ETF to make it easier for average investors to gain exposure to the crypto market. And now, the wait is finally over. The first Bitcoin ETF launched on October 19th, and more are on the way. I first wrote about Bitcoin in late 2017, and I'll drop a link to that article in the show notes because I think a lot of the commentary still holds up. But one main thing has changed for me from the time I wrote that article to when I wrote about it again in April 2021. Whenever possible, I try to think in range of outcomes and probabilities. In 2017, I felt like the two most probable outcomes for Bitcoin was that it would be worth a ton or nothing. Fast forward to 2021, and I'd now assign an extremely low probability that Bitcoin is worth nothing. That makes the more interesting question, I suppose, whether or not today's price qualifies as the being worth a ton outcome I assigned a probability to back in 2017. It's hard for me to imagine Bitcoin returns over the next 4 years will match those of the previous 4 years, a time in which the price of Bitcoin has gained roughly 1,150%. But in reality, as a long-term investor, I'm less concerned about the next 4 years and more concerned about the next 20 or 30 years. While I'm not against Bitcoin or cryptocurrency exposures, the most common investment theses I hear are highly flawed. And I believe the true long-term investor, someone who intends to hold these types of investments for multiple decades, needs to have realistic return expectations. In this episode, I'm going to dig into the common investment theses for Bitcoin and discuss a framework for someone thinking about adding Bitcoin to their portfolio. But first, let's talk a little bit about the new Bitcoin ETFs that are coming to market. The first Bitcoin ETF to launch in the US was ProShares Bitcoin Strategy ETF, ticker symbol BITO. And there are many similar ETFs on the way. One thing that needs to be clarified is that these ETFs aren't backed by actual Bitcoin. They're backed by futures tied to Bitcoin. This is important because the returns from a futures-backed ETF will be very different than the returns of direct Bitcoin ownership because what is referred to as the cost of carry. I found that it's easier to explain this topic using commodities, and most commodities funds are futures-based because the actual physical storage of most commodities is impractical. Plus, there's basically no liquidity in trading in physical commodities. That really all happens in the futures market. The challenge with a futures-based commodity exposure is that future prices and spot prices differ. For example, when a commodity price is expected to rise over time, the futures price will be higher than the actual spot price for that commodity. When this is happening, the market is said to be in contango. And this is kind of a technical term, and I watch a lot of people struggle with it, even financial advisors. But contango simply means that investors are willing to pay more for a commodity in the future than they are today. The premium above the current spot price for a particular expiration date becomes the cost of carry, or in plain English, the cost of maintaining a long position in the commodity exposure. So when you have an ETF that provides exposure to a commodity like oil, it uses futures contracts to provide that exposure to price movements. When an oil ETF's futures contract expires, new contracts must be purchased to continue giving investors exposure to oil prices. But if the market is in contango, again meaning that future prices are higher than spot prices, the fund loses money by rolling forward its contract at a higher cost than what the expiring futures contract is worth. Commodities futures frequently trade in contango, which has historically been one of my primary complaints about the use of commodity funds in general. But it is possible for a market to be in the opposite of contango, where spot prices can be higher than future prices. And this is referred to as backwardation. And in this case, investors earn a positive roll yield. But back to Bitcoin. These futures-based ETFs that are coming to market are going to provide different returns than direct ownership of Bitcoin. Bitcoin is currently in contango, so the cost to carry is likely to have adverse impacts on these funds. And perhaps someday there will be a spot Bitcoin ETF, but probably not until the crypto markets have a more robust regulatory framework. Of course, there are some funds out there today that do hold Bitcoin directly. For example, the most popular one I see these days is Grayscale Bitcoin Trust, ticker symbol GBTC. And it's a closed-end fund that has direct ownership of Bitcoin. A closed-end fund is a little different than an ETF in that there are a set number of shares outstanding, so the demand for that set number of shares can cause the price of the fund to differ quite a bit from the value of the underlying holdings. This fund also comes with a 2% expense ratio, so it's not really that cheap to begin with, but it does seem to be the product that had the most traction for the longest period of time. And of course, you can always buy Bitcoin directly through a number of different exchanges. But should you? It really depends. I don't think you need to. I mean, when I think of my own financial plan, there's no mention of needing to invest in an asset that goes completely bonkers in order to create the wealth necessary to reach my goals. But I understand the allure and excitement that comes from owning an asset like Bitcoin. So let's talk about some of these investment theses before talking about how someone might incorporate it into a portfolio. For much of the past decade, the primary case for owning Bitcoin was that it would replace fiat currency. Nowadays, nearly all Bitcoin proponents agree that that is extremely unlikely. But I do still hear some of what I'll refer to as fanatics still mention this as a reason to invest in Bitcoin. So let's consider for a moment the three purposes a currency should fulfill. The first is a medium of exchange, so an instrument or system that's used to facilitate the sale, purchase, or trade of goods between parties. The second would be a unit of account, a standard monetary unit of measurement of value, cost of goods, services, assets, liabilities, etc. And the third purpose a currency should fulfill is a store of value, a function of an asset that can be saved, retrieved, and exchanged at a later date, and be predictably useful when retrieved. Now, Bitcoin fails as a medium of exchange for a number of reasons. For starters, it's wildly volatile, which makes it pretty impractical to use in most everyday transactions. People often laugh about the guy who bought 2 pizzas for 10,000 Bitcoin in 2010 because it would now be worth over $500 million. Using a medium of exchange shouldn't cause potential for regret. My family gets pizza delivered once a week using US dollars, and never once have I worried about whether using my currency would be a mistake. Even worse, exchanging Bitcoin for goods and services triggers taxes. The IRS treats Bitcoin as property subject to short and long-term capital gains. So if you buy a pizza with Bitcoin that is appreciated in value, you're going to own capital gains tax. Not exactly something you would associate with a good medium of exchange. Bitcoin is also not a viable unit of account because it's not effectively used to quote prices or contracted amounts. For example, you don't see companies releasing financial statements denominated in Bitcoin, nor do you see commodities contracts quoted in crypto. And as for a store of value, the case here is shaky at best, yet it's one of the more common reasons I hear Bitcoin bulls cite. And the thing is, a store of value shouldn't be volatile. Think about the US dollar. I need the US dollar to be a store of value from the time I earn it to the time I spend, invest, or pay my taxes with it. And it does that remarkably well. The same can't be said of Bitcoin or any other cryptocurrency. It's wildly volatile to the point that it completely undermines the purpose of a store of value. And by the way, it's also worth pointing out that a store of value, by definition, has an expected real rate of return equal to 0. So everyone using store of value as a thesis for why Bitcoin will deliver big returns is sort of contradicting themselves, because saying it's a store of value means that they expect to earn 0 return net of inflation over the long run. And there's nothing wrong with that, but usually these same people have much higher return expectations than that. Another popular narrative for Bitcoin buyers in the past decade, but less so these days, is that Bitcoin represents a bet on either the blockchain or an early stage investment in an emerging technology that could change the way people buy or sell goods or transfer money internationally. This is compelling until you consider Bitcoin is simply far too inefficient. Its capacity to process payments is less than 10 per second, which falls way short of realistically being the next Visa or PayPal. The idea of buying cryptocurrency to, quote, buy blockchain doesn't really make sense either. Owning Bitcoin doesn't give someone any ownership in the underlying blockchain, and even if it did, the blockchain technology that underlies Bitcoin doesn't power the same blockchain used by a wide range of governments, corporations, and financial institutions utilizing blockchain technology. Now, the idea that blockchain might revolutionize the world is certainly valid, but, quote, buying blockchain would be like somehow buying HTTP, which is the foundation of any exchange on the web. It might have been part of the function, but the real commodity was the specific URLs. Now, speaking of commodities, the idea of Bitcoin as a commodity is a newer investment case, and on one hand, it's understandable. Both Bitcoin and commodities have values that are determined by demand, acceptance, and usage. However, Bitcoin is not a raw material that carries any useful value, whereas traditional commodities like gold and oil do. Another idea that seems to be gaining some traction is that Bitcoin is a form of digital gold, but this could not be further from reality, and it might require an entirely separate episode to go into those nuances, so I'll leave it at that for now, except to say that even if Bitcoin was the new gold, that's not exactly the greatest endorsement, and I can drop a link in the show notes to an article on why gold as an investment may not be as attractive as you think anyways. Although it isn't a thesis I hear much, the way I see Bitcoin is that it most closely resembles collectibles like art, baseball cards, and Beanie Babies, all of which have aesthetic or emotional value, but that derive their pricing from scarcity in supply and level of demand. Now, after listening to me question the reasons people say they're bullish on Bitcoin, you'd probably categorize me as anti-Bitcoin or anti-cryptocurrency, but that isn't necessarily true. Building a diversified portfolio requires you combine exposures with various risk and return characteristics that behave differently over time. By combining exposures that zig with others that zag, the volatility of a portfolio's overall returns is reduced, and that in turn allows a portfolio's returns to compound at higher rates. If you compare two portfolios with the same average return and different levels of volatility, the lower volatility portfolio will have higher compounded returns and a greater ending value than the portfolio with higher volatility. Of course, every new exposure added in the name of diversification comes with a diminishing marginal benefit. So you have to carefully weigh the expected net benefits versus the degree of uncertainty. Bitcoin certainly behaves differently than traditional asset classes such as stocks and bonds, but it doesn't offer any expected premium for bearing the risk of Bitcoin's price movements. That increases the already high uncertainty around the net benefit from including such an exposure to a portfolio. Bitcoin prices depend mostly on speculation about its adoption and use. And while the increase in institutional adoption has helped drive prices higher, it still lacks an enduring economic rationale that would allow anyone to expect Bitcoin to generate positive real returns over time. Perhaps that'll change, or perhaps you don't care. If you're thinking about investing in Bitcoin, regardless of what I've said, I do think that there are two reasonable ways to go about it. The first is treating it like an investment in an individual stock. That actually seems to be the most logical approach, because even though the risks of owning individual stocks are a bit different, there are some pretty good parallels between the betting nature of owning an individual coin like Bitcoin or Ethereum or whatever coin of choice you may have. Carving out some part of your portfolio to actively trade can actually be a good thing if it helps you stay the course with your long-term allocation. And if you hit it big with your active portfolio, great. And if you don't, well, at least you've limited your exposure to speculative assets. Now, the second way to incorporate Bitcoin into your portfolio is part of a strategic part of your long-term allocation. And with more products coming to market, I suspect more and more people are going to be interested in learning about this route. And if that's the case, here's how I think about allocating to a new exposure. I start by considering the relative market weights of that exposure compared to the relative weights of your other portfolio assets. So for example, the global stock and bond markets have market capitalizations of roughly $70 trillion and $130 trillion respectively. Bitcoin's market value is roughly $1 trillion. So an asset allocator starting point to a portfolio might be 0.5% to Bitcoin. That's 1 trillion divided by 200 trillion. And if you go either of these routes with Bitcoin or other cryptocurrency exposure, I strongly suggest you follow a set strategy and try to remove emotional decision-making as much as possible. One of the practices I find helpful when making investment decisions is writing down the reasoning behind my investment decisions. This forces me to clearly define my beliefs about a particular exposure, but also provides me with honest feedback about my abilities as a prognosticator. With something as narrative-driven as Bitcoin, I'd highly encourage you to answer some simple questions such as, what is your time horizon? Is it 1 year, 5 years, 30 years? And what is your return expectation over that time horizon? So when I think of a 30-year time horizon, if my expected return for Bitcoin is going to be something like 10%, well, gosh, I'm not even sure that that's that interesting given how much uncertainty there is. People might think that the upside is high in the next few years, but again, thinking over the longer term, what do you really think an average expected return for this asset might be? Another question to answer would be, what is the expected range of outcomes, and what probability would you assign to each scenario? How does the position fit into your financial plan? This one's important. What is the thesis for making your investment, and how will you determine if you're right or wrong? I think that's really important, particularly when you have something narrative-driven as opposed to fundamentals-driven like Bitcoin. Another question is, can you tolerate severe losses? Because remember, Bitcoin has already fallen at least 85% on several occasions. 2 more final questions. How will this investment change your life in a bullish scenario? And how will this change your life if the investment goes to zero? All of these questions are designed to help you define the why behind your investment and set reasonable expectations. But just as important, putting your initial assumptions and strategy in writing guards against overconfidence in your ability to predict the future. If your bets pay off for reasons totally unrelated to your original thesis, it's important to know that. So what do you think about Bitcoin? Let me know in the comments section of the show. I'd love to hear from you. And as a reminder, you can always go to thelongterminvestor.com to find show notes, submit questions, and subscribe to my newsletter. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.